So, one of the biggest questions I get while doing my all in one consultations is, hey, Mike, can't I do the same thing by throwing extra money at my principal on my normal amortized mortgage? Is it not going to accomplish the same thing? And I often ask, are you doing that now? And if you're not, why aren't you doing it? And do you know that if you are doing it and you're doing it consistently, you're one of 4%? 4% of Americans actually consistently every month reduce the principal on their mortgage. And so, one of the things that I think holds people back from doing that typically is you can't get that money back. Once you put it in, it is stuck. You have to refinance or sell in order to do that. The all in one is completely different from that. So, to understand why adding extra principal payments to your amortized loan isn't doing quite what you think, you have to understand how the amortized mortgage is calculated ultimately. So, understand, please, that interest is very much so front loaded in, say, a 30-year amortized mortgage, which is the most commonly used, right? So, the first 5 years is almost entirely interest. In fact, it takes about 18 or 19 years in paying a normal 30-year mortgage before that flip flops and you're paying more principal than interest. And I don't know about you, but I don't know that many people that have had their mortgage for 18 or 19 years. Another thing to consider is the reality of an amortized mortgage is the repayment structure has not changed since like the mid 1930s. So, can you think of anything else in American history that hasn't changed since the 1930s? So let's consider the all in one math and understand that every dollar is working for you. So as soon as you inject money into your all in one checking account, it is immediately being thrown and pushed towards your all in one line of credit, which in turn is changing a calculation of interest that's happening that night. So therefore, your money is constantly working for you. So unlike what we're used to now, where we put money into our checking account, it's not doing anything for us. Furthermore, neither is really our savings accounts. Our money markets maybe doing a little bit. But if you can imagine all this money being in your all in one account, thus push towards the biggest debt most of us have, our mortgage, and that is reducing that principal balance, which in turn is reducing a calculation that is happening every day. You are creating a mechanism and a vehicle that is compounding your savings over every single day you don't spend that dollar. Also, as you leave that money in your all in one account and thus reducing your principal, the longer you leave it, the more you save, and you still have full access to those funds. So, unlike the reduction in principal reduction on a regular amortization loan, where you put the money in and you have no access to it after that, you don't see it, it doesn't change your payment. Your payment is static, whereas the all in one is literally recalculating itself each and every month. And therefore, it goes down and down and down over time. I really like to point out as well is the typical all in one consultation for people that I do, they're paying off their mortgage in somewhere around 10 to 15 years. And in extreme examples of highly disciplined, elite earner type scenarios, they're paying it off inside 5 years, sometimes inside two. Sounds crazy, but very, very realistic. So, for instance, my circumstance, I had a 3.625 on a 30-year fixed. I refinanced into the all in one and will conservatively pay off my loan in 8 years and aggressively in four. Understand as well, this loan has been around for about 20 years. It's the only loan that I'm aware of in American history that to date does not have a default. Sometimes I get the question, who is this loan for and who is it not for? So, who this loan is for? The disciplined, the high wage earners, doesn't have to be a high wage earner, but people who have money left over at the end of the month, those who have discretionary income and are looking to speed up the repayment of their loan while keeping those same funds liquid. Those type of people that are looking to achieve inside their mortgages, this is a great fit. Those who are maybe tighter month to month, maybe I like to say if they're rubbing two pennies together, they're probably not going to be a good candidate for this, as it's not going to function. And therefore, a regular 30-year fixed principal and interest loan is fantastic. I wouldn't own a home if it wasn't for a 30-year fixed loan. They're wonderful loans. The all in one is for those borrowers who are a bit more savvy and have a little more at play and really want to make their dollars work for them above and beyond just kind of getting by. Keep in mind, the all in one can be done on a primary residence. It can be done for a second home or vacation home, investment property. You can have several of these. And on a primary purchase, you could put as little down as 10%. A lot of people assume it's going to be 20%, not the case. So you could put as little down as 10%. This is not an expensive loan. This loan is designed to be the last loan you need, at least on that particular property. It is not designed to have to do over and over and over again. And so, therefore, our money is earned over time, not front loaded with all the interest and closing costs and such. I also like to point out this is also available and honestly most common on a refinance. People who would like to not only speed up the repayment of their mortgage, but free up, maybe they have a bunch of equity, free up access to that equity. As a primary residence, you can go to 80% of your appraised value on your home. That is huge, making your equity immediately liquid for you to use. So, if this all in one concept is intriguing to you, I'd like to make an offer to you a free consultation for you to come sit down with me, whether it's on a video or in person, no matter where you are in the country. And I would love to share my screen, show you, run you through a simulation of a side by side comparison to what you have now or what you're contemplating doing side by side with the all in one, and show you just how this could work for your unique circumstance. I am a mortgage strategist. I'd love to help you in any way, whether it's the all in one or any other loan product. I have access to them all. This just happens to be one that I like to speak about a lot because it's so different. So, this is Mike Newman. Again, I'd love to hear from you, whether you have questions about this concept or anything else financial related. I'm here to have a conversation. I'd love to have a conversation.